Over the years, I have learned that the market's pricing a lot of forecasts way ahead of what we actually react to. So they've already priced in the inflationary issues. They've already priced in the energy crisis in Europe. They've already priced in the fact that they're expecting a protracted war between Russia and Ukraine. The markets had started to show signs to me that the dip was done, and it wasn't necessarily going to be as painful or as protracted as I maybe at first had thought. Now, again, like I say, caveat to this, I'm not sitting there saying that we're now at the beginning of the next bull run or anything like that.
Well, a very warm welcome to all of our listeners and our viewers on YouTube as well. This is the Steps to Investing podcast, and I'm Marcus De Silva. Today, we're going to have a chat with a very experienced trader who has his own firm teaching people how to trade. And we're going to get his expert view on all of the regional markets, how they're looking, how they're performing. Because I think it's one of those things when it comes to selecting investments, and I think funds, other types of investments as well, they do have a focus on these different regions. And sometimes it can be a bit like, well, which one do I go for? What's the points of comparison here, really? So we're going to lift the lid a little bit on that and get Ross's view on where we are with markets, given they are constantly moving, constantly evolving. So from Keyzone Traders, I'd like to welcome to the pod Ross Maxwell. How are you doing, Ross?
Yeah, good. Thank you, Marcus. Thanks for having me. Pleasure to be back again. All good. Keeping busy. Markets are keeping us busy. So yeah, all good. Thank you. All good.
Of course, I'm sure they are. Well, do you know what we're going to do? We're going to start with very briefly just on some basics. What's the difference between trading and investing?
I think fundamentally the main basic difference is obviously like your holding times in terms of how long you hold the asset for. Investing, you're holding weeks to months to years even. Your horizon in terms of liquidating the position is a lot longer. On the trading side of things, then you can hold for a matter. Some traders will hold the position for a matter of minutes, up to sort of like a few days, a few sessions, or something like that. So there's obviously a big difference in the holding times. Due to that, obviously trading therefore is slightly a riskier type of investment trading. However way you want to look at it, you have to manage your risk differently. The way that you view your risk will be slightly different as well. And then I think obviously going into a bit more of a deeper level as a trader, therefore, again, because your holding times are much shorter, you are a little bit more dynamic. You can remain a little bit more dynamic. You're less prone to the wider implications of fundamental stuff that's going on around you. So you can change your bias from being short or long, so looking to either buy assets or sell assets, depending on the overall picture in the market in a much shorter space of time. So as a trader myself, rather than I obviously have investments, but rather than an investor, as a trader, even though we've been in one of the biggest bull runs that we've ever seen, that doesn't mean to say I've only been going long and only been buying assets. Like there's been periods during that time when I will have a bearish bias on the market and I'll be going short as well. So it just allows you to remain a little bit more dynamic and have a little bit more flexibility in the markets and be less prone to some of the wider implications of stuff that's going on in the wider world.
Okay, interesting. So would you say it's fair to say that it's a lot more around the fluctuations with markets and some of those more technical reasons why markets might fluctuate, rather than looking too much in depth at the underlying companies and thinking about, how high quality they are, or looking at some of those more core reasons as to why you might invest in those? This is more about much more short-term movements in the market.
Yeah, exactly. So you're not I'm not analyzing specific companies and like looking at their PE ratios and deciding their long-term projections and stuff like that. And in some ways, as a trader, you obviously have to be aware of the wider implications of what's going on geopolitically and in the markets in general, and the longer term prospects of individual assets, shares, markets. But ultimately, you sometimes have to put that to the back of your head and actually just focus on the charts in front of you. And as you say, what your job as a trader is is to take advantage of the fluctuation in price rather than some sort of longer term investment position or view on where a company may head, or an index, or a forex pair or something like that. So you're less inclined to look at the wider implications, and more, like you say, trying to take advantage of the fluctuation in price.
What kind of financial, I mean, there are many financial instruments out there, right? So what do you focus on? What do you trade in particular?
So my background is very much in the equity derivative space and Forex. So I spent many years trading in London and Hong Kong. I was trading South African equity derivatives at the time, so futures and options, which are derivatives of the South African version of the FTSE 100 or the S&P 500 sort of thing. So that was where my experience was, and that sort of led into, when I transitioned from working in the city to actually becoming a full-time trader myself, it was a very easy, natural transition to focus on similar types of products. So I'm very much focused on indices. So I trade the FTSE 100, the DAX, which is the German version, and then the S&P 500. And I do a little bit of Forex as well, which is sort of currency pairs. So I focus on the major currency pairs. So it'll be crosses between, GBP, US dollar, euros, yen, those sorts of currency pairs. Nothing too exotic, just very much the main ones.
And that's interesting. So because you're trading big, broad, so effectively you're trading broad markets and you're looking at currencies and the way that currencies move, then is it fair to say that what influences those big, broad kind of instruments is quite big macro kind of forces? So very top-down kind of elements are influencing how those instruments will trade.
Yeah, exactly. And the other thing, obviously, is different macroeconomic factors will influence different currency pairs and different assets completely differently. So for example, like you have mining heavy currencies like the Canadian dollar, and like even sterling to an extent, with the FTSE 100 is has quite a heavy mining sort of, and the Aussie dollar and stuff. Like they will be impacted a lot more by different geopolitical events than, say, something like a manufacturing heavy currency like Germany or the DAX or something like that. So yeah, and again, that's why maybe as a trader, it's sometimes better to put all of that noise away, because different factors can influence different asset classes and different instruments completely different. So if you can remove all of that noise and just focus on what I'm what I call myself a technical analyst, whereby I read the charts and the price movements, and I determine what, and make my decisions based on that, rather than necessarily like an individual piece of fundamental news. I need to be aware of when those news releases come out. I need to be aware of what they're saying, but actually my decision-making process probably needs to be slightly different to that of somebody who's looking to take a longer-term investment on a particular asset.
Okay, well, let's get on to the markets then and see how they're performing. I mean, very broadly, what would you say are the major driving factors that are pushing or pulling markets around at the moment?
Yeah, I mean, I think it's been an interesting couple of years. Obviously, we had COVID and the whole recovery, the furlough schemes, the money that was put into the markets, and obviously also the slowdowns in the economy due to the economy shutting down for short periods of time. And there is still an element of that we can see weighing on the markets, certainly when it comes to sort of inflationary issues and decision making over interest rate policies and things like that. You've got in Europe, you've got the energy crisis. You've obviously got the war in Ukraine, which one move there can create a whole stream of different things and knock-on effects that could have wider implications. So there's obviously that little bit of nervousness there, but then you've also got obviously the inflationary issues, and then, as I mentioned, the different ways that the different banks and central banks are using the monetary policy to try and control that inflation as well. I think those are the main factors that are driving the markets at the moment.
Well, and I think our listeners are quite aware of those. We sort of discussed those a little bit in market, so it's sort of good to hear you re-emphasize that. Let's start having a look at some specific markets then. Now, the US, this is a very important market globally. I mean, I think around 70% of global shares are US based. So we always have to know what's going on in the US market. What are your thoughts towards it at the moment?
Yeah, I mean, look, I mean, as you sort of said when we were speaking last week, you mentioned that like the Apple itself is the size of the whole UK stock market. So that in itself sort of shows you the size of the beast that I guess that you're dealing with with the American markets. Now, obviously, with the sort of like inflationary issues, as mentioned, we've got they're in a much better position to control the inflationary issues with monetary policy. We've already started to see that come into effect. And, you know, like I remember looking at the back end of last year, sort of like November, December time, I started to see signs that the equity markets especially were showing signs that the dip was over, like, you know, which surprised me. Don't get me wrong, like my own opinion was that we was going to have a bit more of a protracted, deeper issues within the stock market, but it started to show signs that it was recovering. And, you know, the market was down 20% at one point from its all-time highs. Now, anything that you can get at a 20% discount is obviously good value to invest. And we're still 10% off the all-time highs in the American market. So it's still very much undervalued compared to where we were, where we were at the beginning of last year. So it definitely does offer some opportunities. Obviously, we had the post-COVID driven demand, which created a lot of the inflationary issues in America as well. So if that demand comes back once the monetary policy has worked in terms of the inflationary issues, then we're still looking at some good opportunity for growth in America. It's very much the society and people's pensions are very much linked to the stock markets in America, which is why we obviously always see over a period of time the stock markets increase in America. It's just a natural phenomenon that has lasted decades, and I don't really see why that should be any different now. I'm a firm believer, and I've been trading the markets now for 20 years. I've come to learn to read, and also this comes from being a trader, maybe more as an investor as well, but learn to trust what the market's telling me what it's going to do, rather than base my decisions on my own opinions. You know, the markets, I remember looking at the markets back in sort of November and December and being a little bit surprised to see that they were showing signs. And I'm not sitting there saying this is conclusive evidence or that, you know, it's all over and everything like that. But the markets had started to show signs to me that the dip was done, and it wasn't necessarily going to be as painful or as protracted as I maybe at first had thought. Now, again, like I say, caveat to this, I'm not sitting there saying that we're now at the beginning of the next bull run or anything like that. There's still a lot that could happen, but it's still showing signs of some recovery. And also over the years, I have learned that the market's pricing a lot of forecasts way ahead of what we actually react to. So, you know, they've already priced in the inflationary issues. They've already priced in the energy crisis in Europe. They've already priced in the fact that they're expecting a protracted war between Russia and Ukraine. Now, obviously, if something happens to change the narrative at the moment, we've seen slightly the inflationary issues starting to subside slightly, unless there's something that comes about which is not currently forecast, then potentially we could actually have already seen the bottom of this dip. We may not see that big house price slump. You know, they're already talking about in the UK as well. I know we're talking about America here, but already talking about in the UK about maybe the monetary policy doesn't need the interest rates aren't going to go as high as they thought they were 6 months ago. So it's just that sort of it looks to me like it could be on the turn, and therefore, you know, if it is, America's always going to be a very good place to invest. obviously you're, like I say, you're 10% discount to the all-time highs currently. You've been as much as 20% down. So whenever you see those sorts of values, I think it's those value buys. I think there's obviously it can be attractive.
Gosh, okay, so some interesting points you've made there. Still on a discount. You said that it's very linked to their pension markets, their 401ks, I suppose. So there's a constant source of capital fuel that's always going into those markets from a sizable base of people as well. So that's always going to keep it fired up. You also mentioned as well that around the responsiveness to monetary policy. And by monetary policy, we mean that of central banks. It's different government policy, fiscal, monetary policy is from central banks. So they're really the levers of interest rates, but also things like QE as well. Now, you said it's a lot more responsive generally to monetary policy in terms of the inflationary issues that we're having at the moment. Why is that?
So basically, because certainly in America, it's much more responsive because it's much more demand driven. The inflation issues have been much more demand driven and product driven, whereas obviously in Europe and the UK, it's been the inflationary issues are much more due to the energy crisis and the increase in energy bills and stuff like that. Well, that's been a much bigger factor in terms of the inflationary issues in the UK and Europe. Which is you're less able to control those inflationary issues with monetary policy. So the obviously the product demand driven inflationary issues can be controlled by increasing interest rates and putting the pressure, reducing the pressure on inflation that way. So it's much more responsive. Interesting.
So you can drive inflation if you've got lots of people wanting to buy something. There's a big bun fight basically for a particular product. So that can sort of drive price rises, or you can have supply issues. You know, there's a restriction somewhere along the line, which we saw with COVID. But in the case of Europe in particular at the moment, it's also energy and some commodities. The rises there have been pushing inflation from a supply point of view. And that's much harder to deal with the levers of interest rates than in America, where it's really just consumers going mad for some products. And we can definitely dampen that activity by using interest rates, by taking away some of their cash, basically. That's what you're sort of saying there.
Yeah, exactly. Like it's that whole supply or demand driven economy, isn't it? If you're buying something, especially if you're buying things on credit, if all of a sudden you make it more expensive to get that credit, then you're going to buy less products, so the demand is going to decrease. So it's that sort of scenario in America, whereby those increasing of interest rates can suppress demand.
Okay, what about Europe? I mean, you've alluded to some of the issues that we have in Europe, and clearly the big one is that we've got war within Europe, which is certainly a big surprise to everyone last year. What are you feeling about this market?
Yeah, I mean, look, obviously, I think that you said it exactly there. The war in Ukraine, it's war within Europe. It's war on our doorstep for the first time in a generation. So just naturally, it's going to create a much more volatility, more uncertainness around the markets. Obviously, the European Union had high dependency on sort of Russian energy and stuff like that as well. The sanctions that they're putting on Russia is going to have an effect on themselves, not just on Russia. There's going to be that sort of impact as well. And obviously one slight misstep in that war in Ukraine as well can have bigger knock-on effects. So it's a much more fine margin. The risks are of escalation there, and then the like overlaying into the European economies is much higher. So I think that's probably why you've seen sort of like a little bit more weakness. With that being said, though, obviously you've got somewhere like the DAX that's still at sort of like a 10% discount to its all-time highs. So there are still value opportunities there, especially as a manufacturing heavy sort of market. But maybe not. Maybe the risks are slightly more higher because we've got the obviously the war right on the doorstep and those issues with Russia.
Yeah, and sort of, you know, Germany's links with Russia as well, and there's a lot of geopolitical debate going on as they're trying to sort of slightly remove themselves from their orbit, right? And as a market generally, I mean, the DAX, is it quite a strong market? Is it a market that does quite well over time?
Yeah, again, it's another one that sort of generally increases in value over time. Like I say, it is a 10% discount at the moment to sort of its all-time highs. It can be quite a volatile market. It's sort of very much like the Dow Jones, which can have quite big price movements and stuff, and it can be very sensitive. Again, I mean, it's made up of 40. It used to be made up of 30 constituents. It's now only made up of 40 constituents, so it can be very much more volatile to price movements within individual companies, which makes it more sensitive. But yeah, I think that obviously you've got a lot of rhetoric coming from the Russians and from the European Union and stuff around consequences of actions and things like that, which obviously weighs. And like I say, I think over time the DAX is a very good performing market. It can offer value, and it's 10% discounted to its all-time highs at the moment. But just because of those issues on the doorstep with Russia, obviously Germany was very heavily dependent on Russian energy and stuff, and it's trying to move away from that a little bit, but that doesn't happen overnight. That takes time. So you've got these sorts of issues where which is a lot more sensitive to at the moment.
Okay, and then let's hop across the channel. I mean, the UK is, I think it's fair to say it's influenced by a lot of the similar things that Europe are influenced. They're very tightly knitted together, but there are also some differences there as well. So how would you sort of describe the UK market?
Yeah, I mean, look, the FTSE 100, for everything that we've sort of sit there and saying around the inflationary issues and the potential for recessions and all of these issues around. And I mean, let's consider ourselves, we are still part of Europe, even though we're not part of the European Union. So war is on our doorstep. We still have a lot of these geopolitical issues and the energy crisis issues and stuff. But the FTSE 100 is performing very strongly. It didn't recover from the COVID issues as quickly as, say, something like the American markets, which went to the moon basically, and some of the European markets. But in this period, it's performed very strongly. It's actually only last week it was only sort of 50 points, which is less than 1% off of its all-time highs. Now, obviously, not to take it back to the Brexit debate or anything like that, but we have some other factors at play when it comes to the FTSE 100, whereby devalued currency makes the FTSE 100 more attractive to foreign investors, because all of a sudden they're getting it discounted in their local currency. So, for example, for US dollar investors into the British economy, they can get it a lot cheaper because the pound's devalued. So we saw that when Brexit happened, the markets came off, but actually the FTSE 100 rose on the back of that, because all of a sudden the stock markets was a lot cheaper to foreign investors. And we had that big issue around, the debacle of the mini budget and everything like that, where we saw, yeah, exactly, where we saw the pound crumble overnight and get to sort of like levels not seen since the 80s. That all of a sudden that can have an impact on the FTSE 100 as well. So the FTSE 100 since Brexit and over the last 6-7 years has been a little bit more sensitive and reactive to currency fluctuations. And that can explain some of it, but yeah, it's still a fairly strong performing market. It's still quite close to its highs. It's very much a sort of like mining heavy sort of and oil heavy sort of index which had performed fairly well. So yeah, there's still some value there, I think, as well.
Yeah, it's interesting, isn't it? And it's because it has these big international companies in the FTSE 100 whom I'm going to use a 70% figure again, but it is similar. They've got 70% of their earnings are overseas. So actually, when you get a weak pound, then you often get a boost to the FTSE. So because you're getting a currency tailwind there effectively. So and it's been out of favour for quite a long time since Brexit. Trussonomics and the moron premium that was placed upon UK shares was not helpful, but it means there's plenty of value still there. Basically, you think it's quite an interesting one, and also dividends, I suppose, as well.
Yeah, exactly. The FTSE is very attractive to investors as well because of the dividends that it pays. So that's historically always been an attractive factor and a component of the FTSE 100, which makes it attractive. I mean, again, it comes back to this whole thing that if the markets have priced in all of the sort of like the inflationary issues and the war, a protracted war between Russia and Ukraine, albeit as long as there's no escalation or anything like that, and all of the other issues the geopolitical and issues that we've experienced over the last few years. If they've priced all of that in and we don't get any more surprises, then this recession or this downturn may not be as protracted or as painful as certainly myself felt 6 months ago and many others predicted. And I think that just globally that can offer a lot of opportunities. Like I say, there has to be some caveats to this in terms of like there could be something else around the corner which will impact. But currently, what I'm seeing in terms of certainly from a technical point of view, the markets are showing signs that there's still some good value there.
Okay, finally, let's shoot all the way over east and go to Asia. I think the big news there is that China has finally started to relax some of these very draconian COVID restrictions that they've had there. What is your view of those markets?
Yeah, I mean, I don't personally have so much exposure to the Asian markets myself. I don't trade them. Obviously, different time zones and stuff like that. So I'm probably not as well versed or as well read in terms of the issues around that. But obviously, they're already talking about demand for oil and stuff now coming from now that China has opened up again. You're also going to have we know from the way that Europe and America came out of COVID, the impact that had on the economy. So obviously that could have similar impacts over there in China. Again, in terms of it's a very different political space over there. So, with these surge of infections, how the government over there decides to react again is anyone's guess, which obviously offers its own dangers and stuff like that. But I think obviously as long as that is the case, and they are going to remove these draconian and almost let the economy open up again, it's going to offer even more opportunities again out there. Like you're going to have the re-emergence of tourism and stuff like that. See how that's obviously been massively affected over the last sort of 2-3 years. Manufacturing will again. Start progressing. I mean, I personally, I experienced the delays from. I bought a Volvo lease XC60 sort of 18 months ago, but that was put back 3 to 6 months because of the issues of parts and stuff coming in from China because of everything that was going on over there. So all of these things now should start hopefully becoming back to a bit more normality, and that obviously will ease things and hopefully offer opportunities as well.
Okay, finally, just wondered if you had any thoughts on cryptocurrencies. I mean, we've seen a lot of volatility in crypto markets, but even that considered, you would have made an insane amount of money in the past 10 years. So there's been an enormous amount of wealth created, from it, but very volatile. And obviously, we've seen big falls in the markets. What are your thoughts towards it?
Yeah, I mean, look, as I say, I have my doubts or my concerns with cryptocurrencies. Probably comes from a little bit of ignorance, I guess, in a way, in terms of as I said, my experience is very much from the equity derivatives and forex background. I started trading in financial markets before Bitcoin was even known about. So that was where my area of expertise is. That's what I know and that's what I understand. Certain things around cryptocurrencies still concern me, which is why I don't trade it. I steer clear of it. I can see its position in terms of making up a part, maybe a risky part of your portfolio or something like that. I understand. I have a lot of people that I respect very highly who talk a lot more positively about cryptocurrencies, I would say, than I do. I mean, I guess, look, we've seen obviously a massive fall on Bitcoin and cryptocurrencies in general. I think from the highs to where they are now, you're talking sort of 60-70% falls in cryptocurrency. We're seeing a bit of a relief rally at the moment, but that also doesn't mean to sit there and say that Bitcoin is now on this next bull run. Very, very much far from that. As I sort of sat there and alluded to earlier on, just because you're in a bull market doesn't mean to say that there won't be times where you can be bearish on an asset class or an instrument. And the same as Bitcoin is at the moment. Just because we're showing some relief rallies doesn't mean to say we should all of a sudden turn very bullish on it. There was a big sell-off. There are still concerns around some of the cryptocurrency sort of exchanges and stuff like that, liquidity issues. I think for me, there's too many questions still unanswered on cryptocurrencies and Bitcoin in general. As I say, I'm not a cryptocurrency expert. I don't trade it because my areas of expertise, I believe, are elsewhere. But I think, we can certainly see. I run a free weekly newsletter, and I actually analyze Bitcoin for that. Just from a technical point of view, I don't look at any fundamentals. Just from a technical point of view, use my technical skills to analyze that. And we sort of I think we can quite easily see a move back to sort of the 30,000 area, but that doesn't necessarily mean that we're then not going to go to 10,000. It's still very much a bit of an unknown for me with cryptocurrency. And again, I mean, one of my biggest issues, one of the things that I sort of always sit there and say when people ask me about cryptocurrency and why I don't actually trade it, my thing is something that can have a 40% swing on the back of an Elon Musk tweet is something that you have to be aware of the risks that are involved in that asset, and that's not something that I want to open myself up to. So I think if you're going to trade cryptocurrency, you need to have a firm understanding of how to manage that risk whilst you're investing or trading in it.
On that note, Ross Maxwell, thanks very much.
Thank you very much, Marcus.